Hello, and thank you for joining me, Denise of D. Stevens Bookkeeping and Tax Service in Syracuse, New York. I welcome you into 2018 and wishing you a blessed, prosperous new year. Most of us have heard of the massive federal tax changes to our tax structure here in the U.S., known as the Tax Cuts and Jobs Act of 2017. And I'm here today to share with you some of the key provisions of that landmark legislation and how it may impact you as well as your business or your family. It most certainly will affect all of us, and initially it will affect us in a very positive way. We will bring more of our income home, and corporations is anticipated will rev up production and increase their workforces, and we will see whether that will happen or not. So we are moving from a worldwide tax system to a territorial tax system where taxes on business income is taxed only on that income that is generated domestically. That is a major, major corporate benefit, in addition to reducing the corporate tax rate. So the tax brackets were tentatively planned to be four. And as it turned out, the final legislation, we retained the 7 tax brackets as we currently have. But what has changed are those incomes within those brackets have been increased and broadened so that more individual taxpayers will come into those lower tax rates. The top tax rate has been reduced from 39.6% to 37%. The other tax rates are the tax rates at 10%, 12%, 22, 24, 32, 35, and caps out at 37. So what our tax liability will be based on are our incomes, a flat tax, and then a percentage, one of which I named, either the 12, 22, 24, 32, 35, or 37, in excess of a certain dollar amount. Married, filing joint, and surviving spouses who qualify to marry as a married individual, though you may be a surviving spouse, your tax rates and your incomes have been expanded. So if your income is not over $19,050, your tax rate is a flat 10%. 19,000 but not over 77,400, you're at 12%. And then it increases to 22, 24, 32, and caps at 35 within certain income ranges. Those ranges are 77,000 to 400, but not over 165,000. That's the 22%. 165,000 but not over 315,000, that's the 24% rate. 315,000 but not over 400,000, that's the 32% rate. The 400,000 but not over 600, you're at the 35% rate, and everybody else is at 37. So it's a combination of a flat tax plus a percentage, one of which I have named, one of the 7, over the certain dollar amount. The standard deduction doubles. For individuals, it's $12,000. That's your standard deduction. $24,000 for joint returns. Head of households are $13,000. The personal dependent exemption is repealed, so we don't have that anymore. These provisions expire or sunset 2025. Families will get an additional child tax credit. Right now, that child tax credit is $1,000. Well, that's been expanded and increased to $2,000, of which $1,600 up to $1,600 is refundable. The difference will go to reduce the tax, if there is any. That child tax credit is available to families for any child who is under the age of 17 claimed in that tax return, plus $500 for non-child dependents. This credit and this key provision also applies to more affluent households, and this is quite a big difference and a change from the current standard. It is phasing out at $400,000 rather than the current $110,000. This key provision also expires 2025. The alternative minimum tax, which guaranteed a certain tax for certain household or taxpayers taking advantage of certain kinds of deductions. Fewer households will have to even apply or come under the ATM tax or the AMT tax, and it currently kicks in at $164,000 for joint filers. That will increase or kick in at $1 million under the new Tax Cut and Jobs Act of 2017. So that will also sunset or expire in the year 2025. State and local tax deduction. There's a lot of buzz about the state and tax deductions, and this is important to homeowners with multiple properties. It's also important for those homeowners in affluent communities who are assessed heavily for property and school and other assessments. So here's the deal with that. It caps at $10,000. That's the cap on the deduction for property taxes. Now, given that generalization, many homeowners prepaid their 2018 property taxes. Now, the bad news is that some of that prepayment may not be deductible after all anyway. You would have had to have been billed for your property taxes in 2017, which would have included a portion of your 2018 taxes. And if you were not assessed that, then you will not be able to claim that deduction if you itemize, and generally individuals with multiple properties or high tax states generally do, especially those in wealthier communities with higher tax assessments. So that's the only caveat to the prepayment of the property taxes. Okay, so that sunsets and or expires also in the year 2025. Now, how this is going to play out for multiple properties is yet to be seen, because I can see some real problems with homeowners with multiple properties, and there's a cap of $10,000, in property taxes. So that may not apply to commercial property owners. How this is going to be worked out is yet to be seen. The mortgage interest deduction. Okay, so interest on mortgages up to $1.1 million in debt were allowable. That has been reduced to $750,000, and that is on new mortgages. So we believe that the provision is going to allow current properties to continue with the maximum up to 1.1 million on those properties. It is the new mortgages where there's a cap at 750,000. Again, the details of those provisions have not been provided to us, so I can only share with you what the stated generally in the provision itself. The Affordable Care Act penalty for not having health insurance, that has been eliminated, but that's a moot point, because if under the current provision, even if you were assessed a penalty and didn't pay it, well, unless you were entitled to a refund, that would be the only way it could be collected. It couldn't be sent to a debt, one of the new debt collecting agencies hired by the Internal Revenue Service. They could not demand payment of any penalty. So going forward, that's a good thing. The Affordable Care Act penalty is no longer effective with the new provisions of the Tax Cut and Jobs Act of 2017. At most, they could have taken or withheld a portion of your tax refund, but that is now ceased. They are no longer by law able to do that. Okay, estate taxes. Estate tax will remain in place, but the amount shielded from the tax will be doubled. What's that amount? To $22.4 million. Now, most of us don't even have that kind of money, but that 1% that we often hear about, it's those individuals who also benefit from this tax legislation. So the new bill continues to index for inflation in several key provisions, but the new increases will be calculated using more restrictive formula. So whereas certain provisions under the current law kept pace with inflation, under the new Tax Cut and Jobs provisions legislation, that will not happen. Okay? They will be more restrictive, using a different formula that is not equal to inflation. Top corporate tax rate will fall from 35 to 21%, and businesses, the business version of the alternative minimum tax will be repealed. So corporations that were taxed at the much higher rates at 35% are now going to be taxed at 21%. And that territorial tax system that I talked about earlier, that's also more for corporations. With corporations or entities that are overseas, and that are taxed only on that income if that income is moved into the USA. That is, that no longer is the case. So now that has been removed, it is hoped that the repatriate of that income back into the United States, removing that additional tax, is going to cause corporations to expand business and to generate new jobs for those seeking them. Another key provisions for self-employed persons like myself and like you, taxpayers who have some or all of their business income taxed through their individual tax return will receive a benefit. The pass-through income is now includes S corporations, LLCs, partnerships, sole proprietorships. You stand to qualify for a 20% tax-free deduction. 20% tax-free deduction. And this key provision expires also in 2025. And I talked about the companies with foreign income. Rather than bringing it home for fear of incurring higher U.S. tax rates, under the bill, such companies will get a tax break to bring those foreign tax dollars back into the United States. Okay? So it's a repatriate of those assets at 8% or 15.5% for liquid assets. So all businesses stand to benefit from these key provisions. Whether you are a corporation with domestic entities or foreign entity or a S corporation, LLC, sole proprietorships, we will benefit from this key provision. There was a lot of concern with educators and graduate students who are paid for their graduate work, an internship stipend, treating that as income. Well, after some pushback from the academic field, that was abandoned, and so there will be no tax to those graduate income earning students, and the American Opportunity Tax Credit and Lifelong Learning Credit will remain in place. We also get to keep our student loan deduction. Medical expense deductions that were key to individuals who were under the age of 65 at 10%, that has now been reduced to all taxpayers at 7.5%. And it's accessible in the 2017 and 2018 tax year. That is a benefit because individuals with high medical costs, chronic diseases, whether it's cancer or some other very expensive disease to fight, this will bring relief to those families. So that, again, the student loan deduction is being retained. The American Opportunity Credit and the Lifelong Credit is retained, and the waiver for the graduate student loan or student earnings is also kept in place. You will not be taxed on that. Okay? The Johnson Amendment, which I'm kind of undecided or in between that. It restricted political activities from churches and other nonprofits. that that has been upheld. And so the provision that kept nonprofits and churches from directly engaging in political activities, because we all engage in the political process, but it kept those entities from direct involvement and directly participating in political activities, and so that has been upheld. So those are our key provisions. I am really looking forward to this coming tax season with respect to the 2018 and getting my clients prepared and oriented to thinking about the future. And just as a reminder, I want you to really consider that W-4 amendment. Do you need to do that? And if you are a taxpayer, if you are itemizing on your tax return, I think you are one of the ideal taxpayers who should be reviewing that part of your tax planning. All taxpayers should do it, but I think it's going to impact some more than others. So if you are the middle income taxpayer and you're itemizing deductions and above, then you really need to take a look at whether you should be amending your W-4, because I think you're going to benefit tremendously from these new income tax rates. So until our next video, which we will go into the W-4 and more into those who probably should be looking into amending that and what it looks like and who you need to see at your employment to get that done. First, always start with your human resources department, and they will be your first contact to tell you how to do it, what to do, and where it should be submitted. So until next time, thank you for joining me, thank you for listening, and Happy New Year.